Welcome to Investors Hangout. This fortnightly interaction to help you learn more about saving and investing is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with me today is Dhirendra Kumar, the CEO of Value Research, and K.S. Rao, the Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Now, today we're going to be talking about resetting your priorities in the new normal. So, at the moment, investors are facing a lot of uncertainty, and not just in the market, but also more general financial uncertainty. And we've been getting a lot of questions about the kind of changes you need to be making to your portfolios and to your investment plans. Now, Mr. Rao, I'd like to start with you. So, as things, slowly get back to normal and we all get back to work, the virus still looms large, so that hasn't gone away. So, how should we proceed? How should investors proceed?
Yeah, thank you, Rachel, and good morning to everyone. Glad to be back to Hangouts, and it's always a pleasure to be at Hangouts with Dhiren and each one of you. And thanks once again. Yeah, it's as we unlocking is for fourth phase has just started. Of course, it's like people are looking at life is going to be normal. Unfortunately, COVID-19 pandemic has created havoc, which is it's the worst financial crisis over in the last 100 years. And if someone is we are going out doesn't mean that we are expecting that life is going to be very normal. I think we are in for a disappointment, and things will take some more time to settle down. And life was never normal after the air travel was never normal after 9/11 episode, and it took some time to set back and get back. Of course, optimism is right, but optimism is no substitute for honest evaluation. And it's like one of my friends who is a financial planner. He says hope is not a financial plan, and this is a time one need to look at your own financial habits. Having seen during the lockdown, how much you are saving and how much your base necessities which you are working in it, which can give you to look how you can look at the new normal very differently. And to answer your question, probably one need to look to increase their cash reserves. That is either you call contingency fund or you call it as an emergency fund. In the normal course, also we used to tell 6 to 9 months is your emergency fund. But the post-COVID in the current scenario, because the uncertainty is little larger, one need to look at 12 to 24 months of contingency, depending on your lifeline requirement. And this contingency fund is equal to not your income, but it is your total spend, your total net worth. So you need to look at how much you are spending, your monthly spend, which includes your insurance premium, and which includes your debt servicing. And all this put together, it should give a lifeline, and it should be depending on the age and stage of your life which you are looking at. And the second most important thing as we open it up, one should not ignore, is to have sufficient health coverage, which includes COVID coverage available to them.
Great advice. Dhiren, what are your thoughts on this?
Yeah, I agree with him that you need to do the essentials. You need to review your plan. What you thought will be your emergency coverage may not be enough. To revisit that. But more importantly, I think there is something before that which one should take care of, which is making sure that you don't lose your job. If there's a scaled up continuity of your income stream from a job, if that is important to you. And then, of course, all these things are important, but they come later. Be prepared for a scale down, make yourself more useful. That is that, because if you don't have income, savings and investment don't happen, And then, of course, it's time to revisit, review, and scaling up or scaling down your emergency fund. But more importantly, making sure that you don't get distracted, because right now the noise is so much around what is going to happen, the great uncertainty. There has never been a bigger uncertainty than this for everybody, all of us, on all fronts. Financials is not different.
Dhiren, if you could also talk about what are some investment do's and don'ts that we should be following at this time, other than what you both spoke about, having your health insurance, your life insurance, ramping up your emergency fund, and making sure your income flow is in place. What else can investors do?
So a lot of people are getting worried about should they be taking their investment or should they be investing? Have they missed out? Somebody did it earlier. I think it's sticking to your own plan based on once you have reviewed your situation. Is critical, because finally we have to still act in belief, put it a plan, but one has to be hopeful of the future, in the sense that things will limp back to reasonably differently. It will not be back to the old ways, but in a nice way a few years from now. Without that premise, you will not be able to stick to your plan. Today, the question which comes in every question answer session at Value Research is that should one buy gold, or should one sell equity funds because the markets are not in sync with the outlook for the economy. So and this is the time when people are going to be unusually anxious, and they may just be tempted to act in a haste. So having that asset allocation plan, so having a financial plan, having that asset allocation plan, sticking to it, sticking to your investment plan as usual, not acting in haste. So these are important, and not getting carried by what is happening, because it is having a disproportionate impact on our mind when you see that your neighbor is behaving differently, or we are concerned about something. We stop thinking rationally. So I think keeping a cool head, ignoring the noise, and not chasing the hottest investment idea right now, because that may not be a good idea, and that just might be greed driving you.
Mr. Rao, is there anything that you'd like to add to this?
In addition to whatever, what he said, I personally feel one need to look at succession planning at this point of time, because having seen the COVID, the impact, wherever people have suffered, I think it's a pain is much larger. And why we need to succession planning? The importance of succession planning is always there, but COVID has given little more important. I think one it's something like one how we need to write a will, and it's like relook at your will if you're already written, and that will give a clarity of purpose where your money has to go. And this pandemic has really created panic among many, and it's also havoc among many families, and it's like it has also made us realize life is always uncertain. And now this uncertainty time, if something happens to someone, whether you have given your will right, have you written your will, have you given to the, have you managed the, all the nominations for each of your investment, that's the most important. And its will is not equal to the wish, and it's like will is having a legal document. One need to do that. I think I personally feel it's a must, since we are just unlocking, and somebody has to look at their money very differently. And in addition to whatever Dhiren said, will I personally feel has to go forward. In fact, I used to use a term called you go to out with a mask now, and you need to have a little bit of a financial mask. That financial mask, your financial planning ke liye mask, that is M is for manage your wealth with the asset allocation. A stands for asset allocation, and S stands for your staggered investments, and K stands for keeping your eye on your emergency fund and health insurance. Have that mask, and then you can stay healthy and stay wealthy.
Thanks, Mr. Rao. That sounds like really good advice. And for those watching, do get your wills and your succession planning in place. We don't like to think about things like that, but it's always good to. So we now move on to the questions that our viewers have sent us. Now, the first one comes from Jaydeep, and he asks, why are the markets and the state of the economy not behaving in tandem? When are we likely to see some correlation? Now, Mr. Rao, I'd like you to answer this one, since you come into contact with a lot of investors and would have some idea about why this is happening.
Yeah, it's like we have there are two ways to look at it. We are just getting the markets to the pre-COVID level. And during the COVID time, we have seen 35 to 36%, 35 to 40% fall, and which has come back and which has bounced back. And people are looking at, economy is not doing well, why markets are doing well. But honestly, this is a COVID time. It's not a war time. There was a little damage outside. Things are becoming normal, and markets will always anticipate the future. And we are looking at economy which we are into the present. And when you look at discounting at the future, probably markets looks at reasonable. And I'm not saying on the valuations or comment on the markets, but market does its job, and probably market predicts things in much ahead of time. And maybe Dhiren can answer better. Dhiren can add something to it.
Yeah, there are a lot of answers. There are a lot of rationale to why market is going up, simply because investors are not pulling out. All kind of global investors are putting more money into that. Central banks have released all kind of liquidity in the market to ensure that this crisis impact can be marginalized or reduced. Besides that, even the whole correction also turned out to be an opportunity for many investors. who thought that a good part of the market was not reasonably priced and it became reasonable. So that is why a lot of investors also started investing more. And investors have been waiting for a set of companies which were never available cheap. So they got an opportunity to buy it cheap as well. Also, there's a greater realization that, okay, this is a crisis, it happened, and most companies will be impacted. And let's look at it in terms of, I've spoken to many fund managers who say that, okay, 1 year is gone. We have to see that, there will be an impact. There will be an impact for a set of companies. And I don't think that, even in this whole resurgence or the whole recovery that we have seen from the big decline, is there are many companies which have not made a comeback, and there are companies which have gone past the pre-COVID level. So there is a differentiation, there is a discrimination in the kind of companies which are making a recovery. But I would say that we have absolutely no control on all this. We could not have anticipated COVID-19. We could not have, there's too many moving parts, what different central banks and different investors do. What you have far greater control on, what we were talking earlier. Have a plan, the money which you don't need, the likelihood of losing your money, losing your job, the likelihood of income reduction because of this situation. And that is going to, that is far more predictable. Predicting the external things, so focus on yourselves.
Thanks, Dhiren. So, Jaideep, the markets and the economy may not be in sync at the moment, but as Dhiren said, the fact also is that a lot of companies haven't recovered to their pre-COVID levels. So, the best that we can really hope to do is to invest in good funds and good companies and stick to our plan. So, the next question here comes from Sandeep Srivastav, and he asks, what should be the asset allocation mix in the current situation as we are battling with COVID? Also, I have invested in a regular plan of a mutual fund scheme and now find the expense ratio too high. Kindly suggest if and how I should move to a direct plan. Dhiren, if you could answer this one.
Yeah, I would like to answer the first part of the question a little comprehensively, that most investors, should choose one of the 4 asset allocation. One is that if you're getting started, don't do allocation, because you have nothing to lose. You are getting started. So 100% into equity, if you are going to invest 1.5 lakh rupees, and that too in a tax saving fund, don't do anything, have 100% into equity. You need to do asset allocation only when you have built something meaningful. And I would say that we should have broad kind of framework in our mind, that a third of your money should be in fixed income once you are still in your earning phase and accumulation phase. So that if the market, the March kind of situation happens again, you have some shock absorber built into your portfolio. Once you are getting closer to your retirement or post-retirement, then maybe your equal, 50% of it in equity, 50% on fixed income is good enough. Because then you will get rebalancing opportunity meaningfully and more often, and sometimes once or twice in a year. And if you are a very conservative investor, started late, not experienced, it is very unnerving, the whole equity experience. Maybe a third of your money should be in equity, 2/3 in fixed income. And you should keep, rebalancing periodically, or as and when your asset allocation goes out of whack. So this should be your guidance rather than the state of the market, because the markets will misbehave, and many a times, and if you reset your allocation, that itself will do the job. Now, should you move from your regular plan to the direct plan? Ideally, you should, if you don't need any advisor's help. But if you have got hold of a good advisor who does your hand holding, he turns out to be a good counsel in bad times or anxious times, then carry on with this higher expense.
Yeah, I agree with you, Dhiren, but I personally feel if you have a right advisor, it always helps for you, because it is not exactly markets doing right thing. What you do right thing makes you rich. And most of the times the advisor comes back and says, my advisor helps me to manage my emotions most of the times, rather than the markets. And you need an advisor, as you rightly said, asset allocation is a key, and advisor can always help with what is the right asset allocation. Now, since various asset classes, now the most of the asset classes have gone up, and what is that next? How you need to rebalance? I think advisor will play a vital role, and advisor alpha could be much higher. But it all depends on the individual. If you are capable of doing on your own, and of course, direct, you can always have a choice.
Jasmeet Singh writes in to say, I have already lost a lot of money in equity Do you think equity funds will still give good returns in the next 10 years?
I'm very hopeful and I'm very confident that equities will give great returns in the next 10 years. But I think you don't let this loss don't miss the opportunity of learning from the loss. Try and figure out what happened. Did you invest lump sum at one go? Did you become greedy in a very narrow point of time? Because I feel that yes, there would have been losses to many investors, but you can marginalize your losses by having some plan of investment, which is stagger your investment in equity, making sure that you are diversified, making sure that you are not doing trading in derivative, or you are not speculating in the equity market, which also has become very easy. So if you have a plan, you can reduce your losses, because the way to there are two ways of benefiting from market. One is that don't act in a manner. Equity markets will do very well. I'm confident that it will do well over the next 10 years. But I don't know what exactly will do exceedingly well, what will do very poorly. There will be, there will be ups and downs. And if you come only at the uptime, don't invest through the downtime. If you don't invest in good companies or a good portfolio or a good mutual fund, it won't work. So having some plan and sticking to it and understanding little bit is important. So I would say that have some plan. Make sure that you have taken the lesson from your losses and formulate your plan, and don't follow that again, because to make money you also have to make sure that you don't lose a lot of money.
So the next question here is from Gaurav Padar, and he asks, when we move our investment from equity to debt or vice versa, is it considered a switch or a withdrawal, and what are the tax implications?
Rachel, I think any switch is also considered as a redemption. The taxation law applicable to the respective asset class. If I am moving from debt to equity, now it is depending on 3 years or like 1 year, whichever the short-term capital gain or long-term capital gain, which applies to me, it's considered to be as a redemption. And vice versa, the equity is also same. It's considered to be a redemption, and it will be added to your income. It's that's the reason. One, before you switch, you ensure how how it is impacting you on the taxation side. That's the most important thing.
Right. So Gaurav, if you're watching, any STP or any switch that you do from one fund to another will be treated as a redemption in one fund and a fresh investment in the other, and depending on how long you were invested for and whether in equity or debt, you will have to pay the applicable short-term or long-term capital gains tax. So the next question that we have here is from Anubrata, and he writes in and says, I did not have an asset allocation plan so far, but now plan to implement a 75 to 25 equity to debt allocation. While reducing equity, should I sell the winners or the losers? I have been investing in equity mutual funds since 2013 and have been able to accumulate rupees 17 lakh with an annual return of 7%.
Okay, I would say that it's pretty straightforward. Hold your long-term winners and use this opportunity to organize your portfolio. In many years of investing, 5, 7, 10 years, we end up being a collector of funds. So choose, hold your few good funds, consolidate, and in the process, implement your asset allocation, and don't get disappointed with your 7% return, which has been so far. Look at the accumulation plan, and that's the only alternative we have. If this money is for many years, you are doing a great job. Hold your winners, stick to the asset allocation plan, and make sure that you're investing for many years.
All right, now this next question is one that we've been getting quite often of late, especially with the increased interest in international funds. It's come from Manish Thakkar, and he asks, is it advisable to invest in fund of funds? Dhiren?
It is generally, unless any fund of fund is offering you something special. For example, the only case in which fund of funds is advisable is there are many overseas funds, and they are, it's an opportunity for you to participate, and only the fund of fund structure is possible there. So there are some great investment which is available in that structure, and they're relevant. Otherwise, I think if you are clear about your financial plan, if you're choosing one or two multi-cap fund, or you have an advisor, or you are able to do things comprehensively yourself, so you can do without having a fund of fund. That's perhaps Fund of fund have a small disadvantage that they have a marginally higher cost than the usual fund.
Now, Deepak Patan Shetty asks, how should I balance my portfolio in the current situation when the market is overpriced? Also, how do you see gold investments doing over the next 5 years?
As I was telling in the context of another answer, that you decide on your asset allocation and plan accordingly. If your equity has gone up and if you stick to your portfolio, your asset allocation, there might be a rebalancing opportunities. Having an asset allocation in mind is that you are able to, you have some reference point, and it gives you a premise to plan. Because if you are guided by the market, it is very difficult to anticipate what is the market, where is the market headed, how long it can actually remain unreasonable or very expensive or very cheap, when it will turn around. And the big moves happen when you least expect it. So have your plan rather than base it on the plan of the or the state of the market. Outlook for gold, I really don't know, because gold becomes market's favorite when there is when there is fear in the economy, then when there is fear in the financial market. When last time the big boom in gold came in 2008, and now we are witnessing a similar kind of boom. It's up about 50%. But gold has become a very volatile commodity, and it undoubtedly is a store of value. But don't confuse it that it will not lose its value also in the entry. There have been occasions when gold has not performed well and successively for a few years. Right now, gold has gone into a state where many investors are buying gold or gold investments simply because it's going up. And when a lot of investors do that, then things turn around. And so right now, gold has the momentum. How it will be doing in next 5 years, I really don't know. In 5 years time frame, you can be sitting on losses in with gold too. That is a thought which you should not be surprised with. That is also a possibility.
Great. So Deepak, follow Dhirend's advice and have an asset allocation plan and rules for when to rebalance and stick to that. And as for gold, don't invest simply because of momentum. We're now going to take our last question, and this one is from Balan Bhaskar, and he asks, what is a true test of mutual fund performance over a 10-year horizon? Trailing returns or rolling returns? Dhirend?
I would say that look at trailing return. Trailing return is more robust. But when you're looking at 10-year performance, I would say that the simple test of a good mutual fund is that in a 10-year time period, typically there will be two, three up cycle or 2-3 down cycle. And my real test of a fund is that if the fund is doing little better in a rising market and falling little less in a falling market and rising little better than in a rising market, that is a good fund. And in the 10-year track record of if a fund has a 10-year track record, then you will get 2-3 cycles, and that I think is the reason. And also making sure that the same fund manager has been around for a reasonable period of time, so that it will ensure that there is a continuity.
Thanks, Dhirend, and thanks, Mr. Rao, for your insights. For those watching, as Dhirend said, don't worry too much about the news, but focus firstly on stabilizing your income before moving on to anything else. And as Mr. Rao said, ramp up your emergency savings, also taking into account your insurance premiums. So do continue to send in your questions and keep watching. Bye for now.